Europe's Pacific capital, joins me live from Connecticut, and from Hong Kong, Jeff Lewis, Global Market Strategist at JP Morgan Asset Management. Welcome to you both, gentlemen. It's really good to have you with us on the program. Peter, I wanted to kick things off with you because of some comments that you made to me just before the start of the show about what QE3 actually means to you and what the Fed's trying to do to the US economy.
Well, look, this is not going to work. You're not going to create economic growth by creating inflation. He's actually going to inhibit growth and job creation. The crazy thing, if you listen to what Ben Bernanke said in the press conference, this is what his goal is. The Fed is going to print a bunch of money and then loan it out to Americans at ultra low rates so that they can buy real estate, speculate in real estate to drive up real estate prices so they can extract the equity and spend it on consumer goods. In other words, he wants to recreate the very conditions that the Fed created before that created the housing bubble that caused the financial crisis. They want to repeat that. They want to do it all over again because they think it's going to work this time. They think now they know how to orchestrate the housing bubble. They don't. This is a disastrous monetary policy. It's kamikaze monetary policy. The dollar isn't just going to go down. It is going to collapse. You're looking at these foreign currencies. The dollar is going to go through the floor. The dollar index is going to go down to 40. It might even go to 20. I mean, this is going to be in free fall at some point. Gold prices are going to go through the roof. Oil prices are going to go through the roof. Ultimately, there's going to be a crisis, a currency crisis, a bond crisis, because the Fed is never going to produce a vibrant a U.S. economy by debasing the dollar, running money off the printing presses. What we actually need is less money printing. We need higher interest rates. We need more savings. We need more production. We need more exports. And what the Fed is doing is inhibiting that from happening.
Peter, this is certainly one very firm view I notice that you have here. But just how quickly, you're talking about a crisis, that the Fed is causing a crisis, particularly in the housing market. How quickly do you see this happening? Because what we're seeing in the markets today, in Asia, and we also saw it in Europe and the US, is confidence coming back in.
Well, I don't think the Fed is going to succeed in blowing up another housing bubble. That's what it wants to do, but it's not going to do it. There's too many holes in that bubble to reflate it. Instead, all the cheap money is going to go into commodities. It's going to go into gold and silver. It's not going to go into residential real estate like it did last time. So this is going to make life much more difficult for Americans, even the ones that have jobs, because the cost of living is going to go through the roof. And remember, the American economy, our phony economy, depends on our ability to print money and trade it for what the rest of the world produces. But as the dollar is falling through the floor, nobody is going to want to trade their stuff for our rapidly depreciating paper.
Peter, you make some very valid points there. Jeff, in Hong Kong, can we bring you in on this conversation? Do you buy what Peter's saying here? And do the asset markets, the equity markets, really care if QE3 is going to engineer this growth or not?
Well, I think it is good for risk asset markets in the short term, and I have some sympathy with Peter's concerns, particularly this idea that the Fed will keep interest rates close to zero for the next 3 years. That kind of unconditional statement just doesn't make a lot of sense to me. But from the point of view that there was so much uncertainty over QE3, will they go now, will they go later, the fact that the Fed set its stall out and said, well, this is it, this is what we're going to do, it will perhaps remove some of the short-term uncertainty. We know that a lot of firms were holding back on capex spending. We know that durable goods orders were quite sluggish because of the policy uncertainty. So in a funny sort of way, it might be good that Bernanke has now come out and said, well, yes, we're going to tie quantitative easing to the state of the economy. We're going to keep doing this until we see the labour market improving. So that might actually help, in my view.
Okay, so the central bankers have removed that policy uncertainty. We're seeing the positive reaction in the risk assets across the board here today, Jeff. Do you think that this rally is going to last for a lot longer?
I think these policy-led rallies, they can go for a couple of months. They're not sustainable really beyond that. But it's quite interesting. We're now seeing a large amount of liquidity injected into the U.S. economy at a time when the economic numbers are not actually so bad. Industrial production, retail sales, they've been quite good recently. And where we actually are seeing what looks to be the start of a slow, sustainable recovery in the housing sector. So this combination of an economy which is starting to improve, plus a big liquidity injection, could actually be the thing that starts to get things moving. I think the Fed is probably worried about stall speed. Their own research suggests that if growth does drop for a couple of quarters down to the 1.5% mark, then that substantially increases the chances of the economy falling back into recession.
Peter, let me bring you back in here. I would imagine, given the situation as you described it to us just a little bit earlier, means that this injection of QE3 is a bit of a game changer for you in terms of investment strategy. Does it really add to the Asian investment case?
Well, it doesn't change the game. It's the same game. I avoid U.S. assets. I want to invest abroad. I think the U.S. economy is a disaster. It isn't recovering at all. It's impossible to recover as long as the Fed is stimulating. As long as we have artificially low interest rates, all we're going to do is stimulate what's wrong with the economy. The Fed is trying to get Americans to spend more, but we're broke. How can we spend more when we're broke? What we need is more savings so we can produce more, but we're not going to do that with interest rates at zero and the Fed doing QE. So my investment thesis has not changed. It's buy gold, buy silver, get out of the dollar, invest in foreign markets, emerging markets, overweight Asian economies, and one of these days, the Asian surplus nations that are accumulating dollars, that are producing all the products that they're basically giving to Americans on credit, they're going to stop playing that game anymore. They're not going to intervene. They're not going to prop up the dollar, and then the dollar is going to tank. And what's going on right now, Ben Bernanke knows that if he lets interest rates go up, which we have to do to have a recovery, the U.S. government is so indebted right now with short-term paper, and the banking system is so levered up that if interest rates went up, the government would have to default on its debt, and all these big banks that we bailed out with the TARP are going to fail again. So in order to avoid that badly needed restructuring, all the Fed is doing is printing and printing and printing, but in the process, it's going to create an economic crisis far greater than anything that we experienced in '08 or anything that we would have experienced now had the Fed done the right thing, because we're going to have a collapse in the value of the dollar, we're going to have a collapse in the bond market, and this whole U.S. economy is going to implode. And you know what? That's great news for Asia, because the Asian economies have been propping up the U.S. economy for years. They're living beneath their means. They're producing and letting us eat, enjoy the fruits of their labor. The sooner these Asian economies can decouple and let their currencies rise, that's when their own citizens can enjoy the productivity that they deserve.
Okay. All right, Peter, thank you so much for joining us. We're interested to follow up with you in a month or two and see if anything's changed. It's been good to have you with us. And, of course, we'll have more with Jeff Lewis in just a little bit.
The dollar will be a lot lower by then, and gold will be a lot higher.
Yeah, we will. We'll catch up with you in a month or two and see how we're at. Thanks, Peter.